Welcome in. It's really great to have you here with us. We have a truly fascinating mission for today's deep dive.
Yeah, we really do.
We're looking at humanity's transition from a world that has, always been defined by physical scarcity to a world defined by digital scarcity, and then ultimately moving toward absolute abundance.
It's a massive conceptual shift, and the reality is it's happening right in front of us. Understanding this transition isn't just about tracking the latest financial fads or, tech trends. It's about grasping a fundamental re-architecture of global finance.
Exactly.
And inevitably the structure of human society itself.
Right. And whether you're trying to catch up on the bleeding edge of financial tech for a strategy meeting, or you're just insanely curious about where the global economy is heading, this deep dive is designed to fundamentally rewire how you think about value.
That's the goal.
To get there, we are pulling from a massive stack of sources today. We're weaving together some pretty dense economic theory and some incredibly cutting-edge market data.
The source list is wild.
It is. We're looking at historical analyses from the Georgia Journal of International and Comparative Law, a systemic risk report from the World Economic Forum, Promer data from Market Vector.
Also, the market analysis from Growth Turbine and CEX.io.
Yes, and a surprisingly analytical Reddit thread on resource constraints. And we are capping it all off with a visionary 2025 academic paper titled The Infinity Economy.
It's a very diverse stack of materials, but they're all pointing toward the exact same phenomenon. What actually happens to global markets when technology makes physical things abundant and mathematical code becomes the only true form of scarcity?
Okay, let's unpack this by starting at the very foundation of how we currently measure value. If we look at the Georgia Journal paper, it reminds us that classical economics is entirely defined as the science of scarce resources.
Right, that's the baseline assumption of everything we do.
Exactly. The paper brings up Thomas Malthus, who famously made this incredibly gloomy prediction back in 1798. He argued that human population growth would inevitably outpace our ability to produce food,
Leading to absolute catastrophe.
Yeah, starvation, system collapse, the end of growth.
And yet, here we are. Malthus was wrong, and understanding why he was wrong is really the core of our discussion today. The variable he missed was technology.
Technology and innovation.
Right. The Georgia Journal paper uses some fantastic historical examples to illustrate this constant cycle. In 17th century England, they were facing a massive energy crisis because they were cutting down all the forests and charcoal became incredibly scarce.
But society didn't just collapse.
No, the scarcity created an economic premium that drove the innovation of coal extraction. Later, when the sperm whales were being depleted to the point of extinction for lamp oil, the market didn't just accept permanent darkness. Capital rushed into the development of kerosene.
And they mentioned rubber too, right?
Yes, during World War II. When natural rubber supplies were cut off to the West, the sheer necessity drove the invention of synthetic rubber at scale. The takeaway here is that physical scarcity isn't a hard, permanent roadblock.
It acts as a stimulant,
A profound stimulant for technological innovation.
which perfectly tees up this incredibly insightful Reddit analysis we found in our sources. The author there argues that physical scarcity as a concept is actually just a temporary condition
The temporary state.
set by our current extraction limits, our synthesis costs, and the availability of substitutes. And over a long enough time horizon, technology systematically reduces all three of those constraints. The poster points to the diamond market as the ultimate proof of this.
The diamond market is the perfect real-time case study for this dynamic. For generations, we've treated natural diamonds as the ultimate scarce physical asset, right? A pure store of value.
Right.
But the data in that analysis points out that natural diamonds have actually seen their price decline by 25 to 30% since 2022.
Which is wild.
And the reason isn't a lack of demand for diamonds, it's because material science advanced to the point where we can produce indistinguishable, flawless substitutes at an industrial scale. The physical scarcity of diamonds is being entirely eroded by technological abundance.
So if technology can essentially print flawless diamonds now, and eventually print or synthesize other physical goods, it feels like physical assets are losing their premium as a reliable store of value.
What's fascinating here is the logical conclusion of that exact trend. If technology continually chips away at physical scarcity, making material things more and more abundant, then monetary value has to migrate somewhere else to survive.
It has to find a new home.
It has to migrate to rule-based systems.
Right.
This is why the author of that Reddit analysis argues that protocol-enforced scarcity is structurally superior to physical assets. Take a blockchain network like Ethereum, for example.
Okay.
It operates with dynamic issuance and a fixed inflation rate cap that is strictly enforced by the network's consensus rules. That kind of digital scarcity written into immutable code cannot be diluted just because a mining company discovers a new asteroid full of precious metals.
Or a lab figures out how to synthesize a rare earth element.
Exactly. The rules of the protocol are the rules.
Here's where it gets really interesting, because this rule-based scarcity isn't just staying in the digital realm. It's not isolated to native crypto assets. It is actively eating the physical world.
Oh, absolutely.
If we look at the market vector primer, they detail how this migration of value is happening through the tokenization of real-world assets, or RWAs. We all know the basic pitch of tokenization.
Right, setting up a special purpose vehicle to hold a real-world asset.
Minting digital tokens on a blockchain like Ethereum to represent shares of that asset.
And distributing the yield via smart contract.
Exactly. Like imagine a 1 million euro rental property. A company sets up that SPV, mints 1,000 tokens, and sells them for 1,000 euros each. The 50,000 euro annual rental income is just automatically distributed to the token holders.
But the market vector data shows the real volume isn't in fractionalizing retail rental homes.
Far from it. The institutional adoption is where the scale is happening. The data from Market Vector as of November 2025 shows the total tokenized RWA market hitting $35.96 billion.
That's billion with a B.
A massive 719% growth since 2022.
To understand a number that staggering, we really have to look at the specific asset classes driving the volume.
Well, the largest segment right now is private credit, sitting at $18.9 billion.
Wow.
Private credit traditionally offers substantial yields, often around 8 to 12%, but it's notoriously illiquid. Institutional capital gets locked up for years. Tokenization theoretically solves that illiquidity, allowing those debt positions to be traded on secondary markets.
And the second massive driver they noted was U.S. Treasuries, which account for about $9.1 billion of that total. But why would traditional finance use a blockchain for government debt? I mean, they already have highly efficient traditional electronic markets for treasuries.
It's about creating an institutional on-ramp into the digital economy. Tokenized treasuries act as the foundational collateral layer for this entire new ecosystem. Products like BlackRock's BUIDL fund allow massive traditional institutions to put their capital on the blockchain, while maintaining the ultra-low risk profile of a government-backed asset.
Exactly. It gives them a safe, yield-bearing foundation to hold their capital natively on-chain, rather than constantly moving fiat currency back and forth between traditional banks and blockchain networks. It's the bedrock that allows the rest of the tokenized economy to function.
But if U.S. Treasuries are the safe, predictable foundation, what really caught my eye in the data was what happened with gold last year. I'm looking at the CEX.io report, and tokenized gold was the absolute breakout star of 2025.
It really was.
It absorbed nearly 25% of all net RWA growth for the year, expanding 2.6 times faster than the physical gold market.
It's a remarkable divergence. The on-chain version of the asset dramatically outpaced the traditional version in terms of growth velocity.
And the trading volume is what really underscores that. The report states that tokenized gold trading volume surged 345% in the fourth quarter of 2025 alone.
Hitting over $126 billion.
Yes, that volume completely surpassed the combined trading volume of the 5 major traditional gold ETFs. But my question is, who's actually trading this? Is this just retail crypto speculators looking for a new shiny object?
No, and the data proves it's highly institutional. The CEX.io analysis points out that 99% of this massive trading volume is heavily concentrated in just the top 4 tokenized gold assets.
That's a huge concentration.
One single asset, Tether Gold or XAUT, accounted for 75% of that Q4 volume entirely on its own. That kind of concentration indicates professional, algorithmic, and institutional trading, not retail speculation.
Wait, if the crypto market is crashing, like we saw during that massive liquidation event in October 2025 when Bitcoin dropped from 122,000 down to 106,000,
Right.
why aren't these professional traders just fleeing to traditional fiat cash or regular dollar-pegged stablecoins? Why specifically tokenized gold?
That is the crux of the strategy. Tokenized gold has evolved into a highly functional, tactical hedge within the digital economy. During that October panic, daily tokenized gold volume spiked 250%.
jumping from $537 million a day to $1.88 billion.
Traders were actively rotating out of volatile crypto assets and into tokenized gold because it serves as a perfect, highly liquid middle ground. It's shielded from the extreme volatility of native crypto, but unlike a dollar-pegged stablecoin, it offers a real hedge against fiat inflation.
It proves that in high-stress financial environments, these digital real-world assets are functioning exactly as the market intended them to.
Precisely.
So what does this all mean? We have tokenized private credit unlocking billions in illiquid debt, tokenized treasury serving as an institutional bedrock, and professional traders using tokenized gold as a seamless macroeconomic hedge.
Yeah.
It paints a picture of a frictionless financial utopia.
On the surface, yes.
But there has to be a catch. We can't just tokenize the entire global economy, put it on an algorithmic autopilot, and expect zero systemic consequences.
This raises an important question, and you are entirely right to be skeptical. The systemic risks are profound, and the World Economic Forum report outlines a critical one that the industry often glosses over. They call it the paradox of programmability.
The paradox of programmability. Explain how that actually plays out in a crisis.
The very thing that makes tokenization so powerful is the smart contract logic. The if this then that code that automates complex financial transactions instantly. But that automation completely removes human discretion, context, and mercy from the system.
Right. There's no human element anymore.
In traditional banking, if a rumor starts a panic and triggers a bank run, a human banker or a regulator can literally pause operations. They can assess the situation, communicate with the market, and implement a circuit breaker to stop the bleeding.
But on a decentralized blockchain, the smart contract doesn't read the news. It doesn't understand context. It just executes the code.
Exactly. The WEF warns that this programmability magnifies risk differences between assets and can severely accelerate automated, programmed bank runs. If an algorithm detects a slight depegging in an asset's collateral, it doesn't wait to see if it's a glitch. It instantly executes a massive sell order,
Which triggers other algorithms.
creating a cascading liquidity drain in a matter of seconds. We've already seen previews of this in the stablecoin sector. Because of this systemic fragility, the WEF suggests that institutions will be forced toward narrow banking on the blockchain.
Narrow banking. Meaning what, structurally?
They will have to strictly isolate payment tokens, the stablecoins used for everyday plumbing, from the savings or yield-bearing tokens. You simply cannot risk your foundational payment rails automatically draining themselves because a yield-chasing algorithm panicked.
That is a genuinely terrifying thought. A global algorithmic bank run that cascades across asset classes before a human even has time to realize it's happening.
It's a very real vulnerability.
And beyond the systemic risk of automation, there are also some serious practical reality checks in these sources. I want to look at the Growth Turbine report, because they push back hard on this idea that tokenization inherently creates liquidity. Wait, earlier we established that tokenizing private credit and real estate solves illiquidity by chopping massive assets into tradable pieces.
Yeah.
Are they saying that's just a mirage?
They're saying it is a dangerous oversimplification. The industry operates on the myth that fractionalizing an asset magically creates buyers. The logic seems sound at first. If you take a commercial high-rise in Manhattan worth $10 million, almost no one has the capital to buy it.
Right.
But if you tokenize it into $100 shares, anyone globally can buy it. Therefore, it should be highly liquid. But Growth Turbine points out the fatal flaw in that reasoning. A $10 million building broken into $100 tokens is still completely illiquid if there is no actual market demand for those specific tokens.
Oh, I see. Just chopping an unwanted asset into smaller pieces doesn't generate global interest.
Exactly. You still have to convince someone that a microshare of a specific office building in a specific city is a good investment.
Furthermore, they highlight severe structural friction that prevents this utopian vision of global liquidity. In the native crypto markets, you have automated market makers, or AMMs. These are smart contracts that hold pools of tokens and provide constant, instant liquidity for traders.
But there is a massive absence of AMMs for real-world assets.
Because of the regulatory gating and compliance costs.
Exactly. You cannot legally allow anonymous, permissionless trading of tokenized real estate or private credit. There are strict regulatory gates, so the frictionless trading experience breaks down. And perhaps even more critically, there's the challenge of the valuation lag, the net asset value.
The NAV lag.
Yes. If you tokenize a commercial building, how do you price that token minute by minute on an exchange? The smart contract doesn't inherently know the building's current value. It is relying on traditional, slow human appraisals that might happen once a quarter.
So if the commercial real estate market tanks on a Tuesday, the token price is suddenly trading on severely lagged, inaccurate real-world data.
And when investors realize the pricing is opaque and disconnected from reality, they stop trading. And your promised liquidity dries up instantly.
Okay, so we have this incredible technological promise of unlocking global value. But right now, we are fighting against heavy regulatory friction, a lack of market makers, opaque pricing, and the very real danger of programmed algorithmic contagion.
It's a very turbulent transition phase.
But if we zoom out, way out, past the immediate hurdles of tokenizing today's assets, the sources suggest we are heading somewhere much more profound. The 2025 academic paper we reviewed, The Infinity Economy, argues that everything we've talked about today, AI, tokenization, quantum computing, is converging to completely break traditional economic models.
It is a deeply provocative paper. The authors make the case that classical economics from Adam Smith, Marxist theory, and Keynesian demand management all share one foundational, unquestioned assumption.
That they are all simply different frameworks designed to manage scarcity.
Yes. But the paper argues we are rapidly entering the hyper-abundant intelligence economy.
The hyper-abundant intelligence economy, meaning the convergence of these technologies is actually removing the fundamental limits on production.
Precisely. The paper looks at the trajectory of artificial intelligence and advanced robotics fully automating human labor across both cognitive and physical domains. It pairs that with the rapid scaling of renewable energy and eventually fusion energy, which makes power virtually limitless and nearly free.
That's incredible to think about.
If the energy required to produce a good is practically free, and the labor required to design and manufacture it is automated by AI, the marginal cost to produce almost anything drops to near zero. The fundamental constraints of human production vanish.
And the paper suggests this leads to what they call post-money economics. Now, this sounds incredibly sci-fi, but it is presented as a serious, rigorous academic trajectory. Through the quantum ledger value exchange, if production costs are near zero, they propose that traditional fiat money, and even the crypto tokens we are obsessing over today, become entirely obsolete.
They completely lose their function.
But wait, if we aren't using money as a signaling mechanism for what people want, how does the system know to build more solar panels instead of more consumer electronics? How does society function without price signals?
If we connect this to the bigger picture, we have to remember what money actually is. Money is just an informational tool used to allocate scarce resources. If resources are no longer scarce, the utility of traditional money evaporates.
So what replaces it?
Instead of price signals, the paper describes a decentralization singularity. This is a future where hyper-advanced, decentralized AI systems allocate resources based on real-time, granular data about individual and collective needs.
They propose a personalized quantum credit system.
Right. Exactly. Rather than earning fiat currency through labor, citizens would interact with an AI ledger that provisions resources, energy, and automated labor based on ecological limits and personal utility. It completely bypasses the concept of purchasing power.
So the AI acts as the ultimate frictionless logistics manager for humanity. The implications of that are staggering. I mean, society completely shifts away from the extraction and hoarding of finite physical goods.
We stop fighting over limited resources.
And instead, value is generated purely through knowledge, creativity, and collaborative human intelligence. The traditional scarcity-based models of wealth concentration, where power is held by those who control the oil or the land or the capital, would be rendered fundamentally obsolete.
It is the ultimate realization of what we discussed at the very beginning of this deep dive. It is the logical endpoint of technology systematically eroding physical scarcity layer by layer until we reach a state of infinite economic possibility.
It is a massive paradigm shift to wrap your head around. Let's summarize the incredible amount of ground we've covered for you today. We started all the way back in 1798 with Malthus and his fears of global starvation, looking at how human innovation consistently defeats physical scarcity.
Right, from charcoal to kerosene to synthetic rubber.
We examined the massive 2025 boom in real-world assets, where tokenized gold is surging past traditional ETFs and acting as a sophisticated algorithmic hedge for billions of dollars in institutional capital.
While also navigating the very real dangers of this transition.
Exactly. Unpacking the World Economic Forum's warning about automated bank runs and dissecting the lingering myths about fractionalization, instantly creating market liquidity. And finally, we look over the horizon toward the infinity economy, a post-scarcity civilization governed by decentralized AI, where the very concept of money might belong in a museum.
When you synthesize all of these diverse sources, whether you are reading a granular crypto market report or a visionary academic paper, the underlying trajectory is exactly the same. The goal is the absolute removal of human friction. We are systematically building smart contracts, blockchains, and artificial intelligence to manage our resources, our wealth, and our entire global economy without the need for centralized human authorities or manual intervention.
Which leaves us with one final, incredibly provocative thought for you to mull over as you go about your day. If we are truly heading toward this infinity economy,
If we get there.
if we are going to entrust the entirety of our global resource allocation to autonomous AI and immutable blockchain smart contracts to achieve perfect efficiency,
Who actually gets to program the core values into that system?
exactly. If, as the World Economic Forum report stated, code is law, whose laws exactly are we writing into the code that will ultimately govern our post-scarcity future?
It is, without a doubt, the most critical question of our time.
It really is. Thank you so much for joining us on this deep dive. We hope it sparked some new ideas for you and challenged how you think about value. Until next time, keep questioning the code. Take care.
1, 2, 3, 4.
Yeah.